Every economic entity must present its cash flow statement to all its stakeholders. Number 1. Cash flow statement. The cash flow statement, CFS, measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement complements the balance sheet and income statement and is a mandatory part of a company's financial reports since 1987. How to use a cash flow statement. The CFS allows investors to understand how a company's operations are running, where its money is coming from, and how money is being spent. The CFS is important since it helps investors determine whether a company is on a solid financial footing. Creditors, on the other hand, can use the CFS to determine how much cash is available, referred to as liquidity, for the company to fund its operating expenses and pay its debts. Number 4. The structure of a cash flow statement. The main components of the cash flow statement are: Number 1. Cash from operating activities. Number 2. Cash from investing activities. And number 3. Cash from financial activities. Disclosure of non-cash activities is sometimes included when prepared under the Generally Accepted Accounting Principles, GAAP. How is cash flow calculated? Cash flow is calculated by making certain adjustments to the net income by adding or subtracting differences in revenue, expenses, and credit transactions, appearing on the balance sheet and income statement, resulting from transactions that occur from one period to the next. These adjustments can be made because non-cash items are calculated into net income, income statement, and total assets and liabilities, the balance sheet. So, because not all transactions involve actual cash items, many items have to be reevaluated when calculating cash flow from operations. In CFS, we can see that the cash flow for the fiscal year 2017 was $1,522,000. The bulk of the positive cash flow stems from cash earned from operations, which is a good sign for investors. It means that the core operations are generating business and that there is enough money to buy new inventory. So, as you can see, every economic entity must present its financial information to all its stakeholders. The information provided in the financials must be accurate and present a true picture of the entity. In the next lecture, we will study the various terminologies of accounting. Thank you.